Good afternoon, everyone. It is Wednesday, March 25th, and we're ready to review the markets like we do every Wednesday. My name is Stock Darts, and if you like what you see here today, you can always follow me at Twitter at Stock Darts. You could visit YouTube, visit Stock Darts, or you could go to patreon.com/StockDarts, where I post weekly blog content, typically posting either trade ideas or names that I put on watch lists, and just basically going over how I go ahead and attack each week depending on what type of environment we're in. And we typically try to identify that environment on Wednesdays like we are today. So we're going to do the usual. We're going to take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we conclude that, we'll take a quick look at the US dollar, see how it's behaving, see if it's affecting gold, silver, oil in any way. And then from then we'll move on to chart requests. Anyone in here, if you have a chart that you want me to take a look at, feel free to add it into the chat, and we'll go ahead and take a look at it during the latter half of today's stream. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500, and we're looking at it at ETF SPY. Now, we finally got a bounce. We're finally moving up a little bit, and now the question becomes, is this a temporary relief bounce, or have we found a definitive bottom? And I suspect that it's going to be a little bit difficult to tell, but my suspicion is that we probably just found a relief bottom rather than a nice bottom. Hi Ray, good to see you in here. Good to see whoever else is in here. We have a few viewers so far. But yeah, so we'll go ahead and analyze where we stand in the market and where we can expect to bounce up to, or where we will turn around and drop again if that's the case. And like I said, there's still a lot of bad news that probably can come out. And this market, while we are finally getting a bounce based off of the idea that we're finally going to get some stimulus coming in, I think that we might have gotten some nice temporary capitulation, but I think over the long haul, there's still more downside in this market. So I'm not too excited about going long here. For those of you that maybe have been going to my Patreon page and watching what we've been doing the last couple of weeks, you'll know that I have been looking at long names. I've been outlining plays that I think will stand better in this type of environment, and by that I mean a market that's going to slow down quite substantially. But because we're forced to stay at home and because we're self-isolating, there's certain names that are going to perform better, and those are the ones that benefit from the general populace staying at home. And so that's been my focus over the last couple of weeks, and that little portfolio has actually done very well, and it's outperformed the market by quite a bit. And I suspect that it will continue to do that for the next few weeks, or even for the next, the coming months, depending on how long we stay quarantined and how often we continue to shut down cities and keep people trapped in their homes. And as long as that continues, then I think the general idea is to stick to tech names that benefit from people either working at home or just generally speaking not going out in public. And so that's been the focus to the long side. Now, considering we're finally getting a bounce, if we could bounce for another couple of days, I think we'll reach a point where we can start looking at shorts again. Because again, I don't think we're out of the woods. I think the potential economic ramifications of what's going to happen with the entire world shutting down for basically a month or two at the least is still not completely apparent to everyone. And I think as we start to see more and more companies start to release either their earnings or start to just sort of change their guidance outlook on what's going to happen during the earnings calls, we'll see just how much the market or how much the economy has slowed because of this. And at that point, we'll see whether that's enough to bring us down. There's also always the harbinger of more bad news coming overnight. Any time that we look, if there's a sudden spike in either infections or deaths, say New York or one of the major cities, it might be enough to turn the market right back around. Or if more companies continue to try to shut down, once we start to see really the impact this is going to have on the workforce. So I don't think that we're done dropping. So I think looking at potential shorts if you're a swing trader over the course of the next couple of weeks is probably a good idea. Hopefully we continue to bounce, and at the very least that way, if we do turn around and head back south, we'll just come back and retest the levels that we just started to define as support, rather than breaking through them and falling even further down the spiral as we head even lower and lower in the market. So ideally we'll get a bounce, and ideally we'll continue to move upwards, and that way we'll have a little bit of leeway and a little bit of cushion when we do turn around and head south, because I'm pretty sure we're not done dropping. It'd be nice, again, like I said, to at least recover maybe a third to half of this move. That way, when we do turn around and come back down, it's with less volatility, and we just come back and retest support levels rather than breaking through them and trying to figure out where the new ones lie. So let's take a look at the individual levels here on the S&P 500 and where we could pinpoint spots where we could consider them resistance or support, and types of trades or what kind of action we want, and depending on where we go. So the first thing we're going to do is real quick take a look at the longer term chart of the S&P 500, so we can see where we stand compared to what we've done over the last 4, 5, 6 years, right? So here's a look at the S&P 500 since about 2016, and actually we'll go back to 2015 so you understand exactly where we stand and what we've done. So the market spent basically 2.5 years trading sideways between 2015 and 2017, and then it had a nice climb post-election, and we rallied basically for a year and a half, and then we ended up trading in another broad range for another couple of years, and then we broke out at the end of last year and the start of this year, and really looked like we were trying to extend and start a new rally, very similar to what we saw in 2017. Then, of course, that's when the pandemic really hit, and that's when things really got out of hand. And at that point, we sliced right through a lot of critical levels, right? So in the beginning, we were hoping that maybe we could stay above the range from last year, and if that was the case, then we would be able to shrug it off and eventually maybe even start to rally again. But once we started getting caught up in the middle of last year's range, you knew that things were getting pretty ugly, and at that point, we were just kind of hoping that we wouldn't go backwards. But unfortunately, we've gone backwards, and we've sliced through the entire range, and now find ourselves below that range. And that means when we come back up into it, that the support level of that range should now become pretty strong resistance, as you have a lot of overhead supply and a lot of traders that are now going to be underwater at key levels, that are looking to unload and maybe get away at try to recoup some of their losses. And so think about it from this perspective. I'm sure most of you are have holdings right now that are down. And you have to imagine there's a lot of people just like you. It's one thing, a lot of people forget that most of the population behaves or thinks a lot like them. So if you have a portfolio that's down a lot, and you're just hoping, well, now that we've got a little bit of a bounce, I can close some positions and get a little bit of relief because I can raise some cash knowing that at least I recovered some of that drop. You have to figure most of the population or most of the traders are thinking very similar to you, right? So there are a lot of people right now that have taken big hits and didn't want to raise cash at the bottom, but are in a position now where they need to raise cash. They need to liquidate some holdings, whether it's just to withstand these couple of weeks or months that they're not going to be able to work fully or whatever it is, or if it's just that maybe they're still scared the market's going to drop further and they want to be able to close out some positions ahead of time, right? So they're going to look at areas where they consider it break even, or where they think that there's basically these levels that were support are now resistance because of that. And so they're going to be looking at those levels at places to unwind and unload some of their positions. And one of the key areas is going to be over here as the S&P 500 starts to hit 256. So if we go back to the daily now, you'll see we looked at that level last week, and you can see it was a pretty critical level. We tried to bounce very strongly. We failed, and then the next 2 days we were trying to reclaim that. And I'll zoom in for you guys. And you can see we ended up failing pretty stiffly at 255, and then we headed south. Now we're coming right back up to that area, and that's going to be a critical area for us. And if we want this bounce to be more substantial, that's the level we have to break through. I think if we could break through that, we'll make a quick run back up to the 20-period moving average, and then I suspect that's probably about all we can get right now. There's the same analysis we mentioned last week, which was if we can get above that, we'll try to make our way to the 20. Of course, we couldn't get back above, so we failed and we headed lower. And I think it's the same sort of scenario here. We're looking at 255, 256 as very critical resistance. And if we could push past it, I think we've got to move up here to about 269, 268. And then from there, we'll see whether we can actually push through the 20. Typically, when you have such a strong move like we've had, whether it's up or down, the first or second test of the 20-period moving average usually doesn't result in a change in direction. So more likely than not, as we come up and meet the 20, as the 20 comes down to meet price, more likely than not we'll resume and head back lower. And then the key will be, do we head to new lows, or do we start to retest these areas and maybe start establishing support a little bit higher than the lows we printed on Monday. You can see on Monday we went all the way down to 218, and that's going to be hopefully a nice short-term bottom on the S&P 500, and we can use this as a rallying point to start to at least trade sideways. And that's really the key right now. For those of you that are looking at the market and thinking, hopefully we can find a bottom and come back up, really at this point, you're not looking for the market to bounce and make its way back to highs. What you want right now is for the market to break this drop and start trading sideways. More likely than not, that's really the key, is just the downshift back to neutral rather than this big steep drop that we're taking, is to at least start going sideways and start to establish different areas of support where we can start playing a range. And then from there, if we get enough buyers, then we can start looking at maybe going back to the upside. But for now, what we really want is just to kind of stop this drop. As you can see, basically from the middle of February, we've just gone almost in a straight line. We had a 3-day bounce, and then from there, it's like every day that we have a bounce, it's basically negated the very next day, right? So we tried to bounce here on the 10th of March, and then we had a pretty ugly move on the 11th and the 12th. And this was, of course, when the NBA decided to cancel their season, and like dominoes, basically all the major sports and a lot of businesses started sending people home. And then we tried to bounce right after that, but ultimately it turned around and we headed back south. And so far, every day that we get a bounce, we faltered until today. Today's the first time in quite a while that we have 2 days of green action in a row. And so that's a very nice positive. And now the key will be, can we get a third day tomorrow? And if so, then that'll be nice, because we'll make our way back up to resistance, and then we'll see whether people are willing to, whether they're bold enough to hold over the weekend, or whether we sell off as people anticipate some bad news or different types of risk that can be associated with holding over a weekend where you can't trade. So that'll be the key, is really how we close Friday. But ideally, if we can close strong today and tomorrow, we'll at least make ourselves we'll make ourselves in a better position here, where next time we drop, we actually have levels of support that can try to hold the market from dropping further, and we can see if buyers are now going to establish this 237, 238 area as key support. So first level of strong resistance is 256. That's a critical level. If we can get above that, I think the farthest we can go is probably about 267. I don't think we pass this area here in the 20-period moving average. And if we falter and we turn right back around even from these levels, then ideally we want 237 to hold the support. And if not, well, then Monday's lows at 218 are really the critical level. And that's the level we don't want to lose. If we lose that level, then again, I think all bets are off as to how far we can drop. And I think if we lose that level quickly, then it's going to be it can get ugly really fast. So, if we lose 218 in 2 or 3 weeks, that's a little bit different. But if we come back down to that level tomorrow or Friday or Monday, then I think that means the market is still looking to head south and to head south fast. So I think at this point we have nice levels that we can kind of depend on, and I think at this point, with the nice action that we've seen these last couple of days, and really what we've seen over the last week and a half, where we could see buyers finally starting to come in, and even if we lost ground over the weekend, Friday and Monday, we did come back to this level. So we're finally starting to see a level of support start to develop. And now the key is whether we can push through that first level of resistance, or whether we're going to get stuck here and maybe start heading south. And if we do, again, I think right now we can hope for, at the very least, a nice little consolidation range between 256 and about 232, 231. And if we can at least trade sideways there for another week or two, that'll give us a little bit of a breather before we turn around and maybe try to probe new lows again. And if we're lucky, maybe we can push past that and start probing a little bit higher. And if we get back into that range that we spent most of the last 2 or 3 years in, then at the very least we can say that we've moved back to sideways, and the market is at least for the time being done with dropping. Now again, a lot's going to depend on overnight news, so it's still kind of scary. But a lot of times, if the market is finally ready to bounce, it'll shrug off the news, because at this point a lot of that is already priced in. So that would be the hope if any of us are playing to the long side. Now again, if you're playing to the short side, if you think this is going to continue dropping, well, then you want us to hit these support levels anyway, because that's going to give you better risk reward on potential short plays as we move forward. Because the last thing you want to do is continue to have to chase shorts when names that you think are going to get hurt during this economic slowdown, they just continue to drop every day. And if they don't ever bounce, you don't really ever have good opportunities to get in with good risk reward on a trade setup. So a bounce really is in everyone's favor right now, those that are long and those that are looking to short. So hopefully we'll get that. Hopefully it'll continue and we'll get at least another day or two. Then from there, as we start to approach these levels of resistance, we'll see what happens next. Now, we take a look at the NASDAQ. It's interesting. I think the NASDAQ is still the area of relative strength, and it's had the strongest move. However, today it's actually the weakest of the four indices. It's only up about 1.5%, as opposed to 3 to 5% like the others are. And I think a function of that is just that the Nasdaq has been stronger the last throughout the last month or two, and today's bounce is, for the most part, based off of names that have been really hammered. So you're getting a lot of the bad names. A lot of the names that have been really really hit hard, like the cruise lines, airlines, Boeing. Those kind of names have been hammered, and now that we have a better idea of what the stimulus package is going to bring, those are the names that are finally starting to recover a bit. So what we're getting today is a lot of the recovery today is in a lot of the names that I think are actually good shorts in the near future, and I think have been really struggling. And the stronger names that have not dropped as far are bouncing less because they didn't really have, they have a lot of ground to catch up anyway, but not as much ground as some of the names that have really been hammered. So that's one of the functions of why the NASDAQ is only up about 1.5 today, or 1.5% instead of what the others are doing. But overall, this is still the strongest of the four indices. And I think it's still, if you're focused on the long side, if you're trying to allocate or reallocate your positions to weather the storm, as so to speak, as far as what's going to happen as we continue to stay at home, I think that you still want to look at tech names, and I think you want to focus on a lot of those names that I've mentioned on my Patreon page over the last couple of weeks. And if you do so, you'll see that those names are going to hold up better. And so they may not be up as much today, but that's only because they haven't dropped as far as some of the other names. And if you take a look again at the Qs in general and tech, you can see we haven't really lost as much ground as the others. We're not below that range that we spent 2018 through 2020 in. If you come back and take a look at what we've done since about 2015, like the S&P 500, you can see we're still well above a lot of these areas. We had that base that we spent for a couple of years trading, then we had the election rally, and then the range that we spent the last few years in. We've only made it to halfway, right? So again, tech is holding up better than others. Like I said, if you're looking to try to reshift money in your portfolios, you should be looking at tech names, as I think that they're going to be the ones that hold up better. Very specific tech names, of course, not just any random tech name you like, but the very specific names that are not going to be hammered, the ones that rely more on internet commerce, are going to do well, as opposed to the brick and mortar shops and the names that are energy related that are really going to struggle from such a strong slowdown in the economy. And again, as you can see, the Qs are doing really well compared to the others, obviously, and have not lost as much ground. Now, we go back to the daily chart. We try to analyze where we stand and where we could go forward. You can see we actually broke through this area around 185, which was kind of critical. That's kind of analogous to where we were in the S&P 500 here. So I'll go back to the S&P real quick. So you can see this was the drop we had on the 12th, which was after the day that all the sports teams, all the sports leagues decided to cancel their seasons or postpone them. We had that bounce and then we dropped. So this area became critical, right? So on the NASDAQ, we're actually kind of going through that right now. So that's this area here, right? So relatively speaking, even though the NASDAQ is up a lower percentage today, it's actually going through a pretty critical reference point that we're looking at as far as trying to judge whether we're ready to recover and move forward in the market, right? So in this case, it looks like the NASDAQ wants to head up and test its 20-period moving average. It looks like it's a day ahead of what the S&P 500 is doing. And if that's the case, then we can maybe hope that the S&P is going to follow through tomorrow and do the same thing. And if that's the case, then we should see the NASDAQ hit its 20-period moving average tomorrow. And that would be, of course, that's the optimistic view and the one that hopefully occurs. Now, on the flip side of this, if we turn around and fade and the NASDAQ loses 181, this 181.80, basically 182, and heads right back down into the 170s, then that bodes poorly for the markets. That means that we're going to probably head all the way back down to 170 on the Qs and possibly lower. So if you're bullish or you're looking for a bullish sign of the markets, then you want to focus on the NASDAQ and you want to see what the NASDAQ does. However, you also want to focus on it if you're bearish or if you're worried about a drop, because I think that this is one of the critical levels that we need to hold over the next couple of weeks if we want to have more than a 2 or 3 day rally. If we want to have a rally that lasts more than a week, or at the very least, if we want to have constructive price action, where we continue to sort of move forward and establish a stronger bottom, then we don't want to lose this level around 182. And if that's the case, then the NASDAQ is one of the more important indices right now to watch and see how it behaves now that it's breaking through what I consider to be a pretty important short-term level. Now, long-term, we want to get back at least to the 200 pair moving average, somewhere around 200. I don't think that we'll get there from here to next Wednesday. I think that's still a pretty big move upwards, and we need to see a really strong reaction to whatever the stimulus package is that the government's coming up with, and only if the market really likes it will we make our way back up to 200 and above. I think right now, like I said, typically when you have these strong moves, the first time, probably the first 2 times you test the 20, you don't really push through it, and if you do, it's maybe a temporary 1 day dip and then or 1 day move, and then it comes right back up, and you can see that happen on the way up, where you have a strong move and then you come up and you test the 20, and you can see we tested the 20 a few times before we eventually changed course and went in a different direction, and that's going to be the same here most likely, where we're going to need to actually test the 20 and then from there see if there's enough sentiment to change, because right now it's really just showing that no one has confidence in the market right now. And keep in mind, again, I know you look at when I mention stuff like this, you think, well, that's just a mathematical squiggle. It doesn't really mean anything. But no, this mathematical squiggle tells you what the sentiment in the market is, right? This is well, you should look at these the trend lines and these moving averages. They're basically visualizing what the market is thinking. Right now, obviously, most market participants are worried, and that's why we're seeing this drop. And as we get to that, it's just going to be, we have to overcome sentiment in order for these moving averages to turn back in the other direction. And at the moment, sentiment is very decidedly negative, and I don't expect it to change the positive that this quickly. I think it's going to take a while before traders gain confidence in the market again. So we can expect us to find these moving averages to be resistance, and for us to struggle to break through them and to change the direction of the overall market. And if we do change the overall direction, it most probably will be that we start trading more sideways. And so that's really the hope with the NASDAQ right now, is that we can make our way back up to the 20-pair moving average, and then as we do, we can hopefully do something like this, right? So we'll make our way up hopefully over the next day or two. And then the next time we drop, ideally, we'll hold above this 182, and then from there we could just kind of trade sideways, and then maybe try to make our way up, or even if we do roll over, at that point we would have had enough support at a higher level that we're not expecting to just crater through and form new lows as we drop. Now, of course, the opposite of this would be the the negative scenario, which would be if we don't even try to bounce tomorrow, and we just head right back south, in which case we'll make our way pretty quickly back to the low 170s, and as long as we hold above 169 or so, I think we're fine. But if we start to go into the 160s, then I think we need to look out below, and it could get ugly again. So hopefully, like I said, we've started to establish some positive market behavior, and hopefully that will continue over the next. Hopefully that'll continue over the next couple of days, and maybe even in the next week, and give us a little bit more leeway to the downside once we do turn around. And like I said, I think it's definitely not a if we turn around, but when we turn around, because we will definitely have to test these levels of support again. There's no way that the market is done selling, and there's no way that traders have regained confidence and are ready to just hold back to highs. There's going to be a lot of traders ready to sell. The higher this market goes, the more they're going to want to get rid of their stocks and cut their losses rather than be caught with their pants down if we do turn around and drop again. All right, so let's take a look at the Dow. The Dow Jones doing very well today. A lot of that doing, Boeing is doing well, and the Dow has been beat up pretty strongly. And like I said, a lot of the names that have been beat up very strongly are the ones that are recovering today. And we can see that on the Dow with a nice strong move today of almost 5%. Relatively speaking, you can see the weakness compared to the NASDAQ, well below all of our key areas from the last couple of years. Again, we'll go to the weekly chart, and you can see we actually almost made it all the way. Did we make it? We made it. Look at that. We actually hit the breakout from the 2017 election, from where we really took off and ran. We actually made it all the way back down to that level. So, relatively speaking, very, very weak on the Dow Jones. So we've given up basically the entirety of the move that we've had during Trump's presidency, and made it all the way back to the start. Now, we did bounce very strongly off of that, and as you can see, we've made our way back up, but we're still well below the bottom of that range that we spent the last couple of years, and we're struggling right now with this little dip that we had at the end of 2018 when the market really got scared, and that's basically acting now as a temporary level of resistance. But I think the more critical area to pay attention to is up here around 235. So let's go back to the daily chart and see where we stand now and what we can look forward to. So the key level here, so the temporary level that we want to look at again is that March 12th to March 13th area, right? And you can see the Dow is actually breaking through that. So in the short term, this is actually, relatively speaking, a nice bounce, right? Because we've made it back through this big turnaround in the market, right? And again, I want to point out this was a huge move here when basically all the sports leagues decided to start canceling their seasons or postponing their seasons, and we had the first bounce, and then we came right back down and failed. This is a pretty critical level to get back above, to show the sentiment is shifting. And the fact that the Dow is breaking through that is actually very positive. And again, I think shows that traders are hoping the stimulus package is going to really help the market and save us from a further drop. Now, this is another one that would be nice to hold above it. If the Dow Jones falters here and ends up closing below 213, 214, it's a negative, but I don't think it's as negative as if the NASDAQ falls back below that level. So while I do think this is a critical level, I'm more concerned with what the NASDAQ and the S&P 500 do as they hit these levels rather than what the Dow is doing. But it is nice to see the Dow getting back above that. And hopefully it can continue to gain some strength, because, again, if it can start rallying here, then that'll show that a lot of the names that are beat up, which the Dow Jones actually has a few of them, are starting to recover a bit, which is going to help us in the long run. And at the very least, like I said before, gives us some more room to fall and still hit support levels if we do turn around, or when we do turn back around. So the critical levels, again, are about 214. If we falter and fall below that, I think we're going to head down to this 204 to 200 area. And ideally, we can hold there rather than come all the way down to Monday's lows. If we go down to Monday's lows again, I think that it's a very bad sign if we hit this in the next week. We don't want to be back down here. If we're back down here, we're definitely going to print new lows and probably head quite a bit further south. So what we want right now is to stabilize and trade sideways. And whether that means that we find support around 200, or whether we find support around 213, or whether we find support around 225, not really the issue. The issue is just we hope that at one of these three stages we just trade sideways. And hopefully, like I said, we'll bounce at least another day, come up into our 20 period. And then from there, if we do drop, we've got some levels of support that can maybe stabilize the market. And we can start to find a new range to trade in, rather than continuing to basically head south every second or third day, depending on how bad the news is. So that's the key here. Now, as far as the Dow, there's nothing else. All the analysis I mentioned with the S&P 500 and the NASDAQ stands for the Dow as well. Relatively speaking, a little bit weaker, but overall, getting a little bit of strength here. And the behavior is going to be basically the same as what we saw with the other two. Now, the last index is going to be the one that's very different, which is IWM and the small caps. As you can see, the small caps, and we're going to go to the weekly to show just how weak they've been. The small caps have really struggled. Not only did they come back to the 2017 election breakout point and fail, they've gone all the way back down to that range that we spent 2015 through 2017 at, and actually broke down below it as well. They came all the way down. If you look at IWM hit 95. So it's been almost a 50% cut in IWM over the last month or so. And you can see small caps they've just been hammered relentlessly. Traders have no confidence whatsoever in the small caps, and it's pretty obvious in the behavior that we've seen in the price action. Nice to see that we're up a little bit today, but even today they're only up 2.5%. Nothing spectacular. And at this point, I have very little confidence in judging the IWM, the small caps, and expecting them to behave any better than they've done recently. Um, at any sign of market weakness, the small caps are going to get hit. So um, if you're looking at short names, and there's a theme that we can cover a little bit later today after we get some chart requests. We'll look at certain names that we think are going to get hit hard. But overall, if you're just looking for names to short and you don't want to go ahead and take advantage of the more popular ones that you feel are maybe too are overdone, you should just look at small caps and take a look at which ones are going to get hit, because for the most part, they can't. There's not enough confidence in these names right now, and they continue to get hit hard. And it's going to take a long time for consumers to gain confidence back in these, or traders to gain confidence. You can see we are attempting to bottom. We are coming through that same March 12th, March 13th level. We are trying to break back above that, right? So it's a positive as far as that's concerned. But relatively speaking, there's so much room to go up, so many potential resistance levels, so many gaps to fill, that it's going to take a while for IWM to reach any level of real resistance. Now, if there's one index that's more likely than not to not reach the 20-pair moving average, it's going to be IWM. If we can get back up into this 117, 118, that'd be spectacular. At that point, maybe the 20 can come down and come close to it, and then from there we'll see. But if anything, it's probably going to falter here, and if it does and it comes back down to test new lows, then again, we have to be careful, because this could be showing us that the rest of the markets are going to follow suit. But ideally, we'll get one more day of buying, maybe two more, and we'll break above this level of 111, 112, and we'll start to hold up in this area. And like I said, what we want right now is not necessarily to make up the entirety of this drop. What we want right now is for the drop to stop, and for us to trade sideways. And the best way for that to happen is for us to establish one of these levels that once we push through it, we can come back and count as that as a potential level of support where buyers are going to step in, rather than looking at every single time the market turns red to look at lows. Now, on the bright side also for IWM, you can see some nice buying wicks here. There's 3 days of very strong buying at the bottom. So hopefully we have established a good long-term bottom here on IWM. And maybe if we could just stay above, you can see this $100 range now could be a pretty critical level of support, and hopefully can hold. And if that's the case, then like I said, right now what we want more than anything is just for the market to stabilize and start trading sideways, and give us a range that we could depend on for at least the next month or so. And then from there, we'll see what happens as we move forward with this, with the quarantines and the self-isolation, social distancing and all that stuff, and we'll see just what kind of impact that has. And then from there, we'll see whether this can hold or not. But at least give us a month of breathing to be able to try to establish these ranges and try to figure out what we could play off of as far as that's concerned, right? So that's the four major markets. I think, again, this week is positive. This is the most positive that we've had, the most positive action we've had in quite a while, just by virtue of having 2 green days in a row. Last time we had 2 green days in a row was way up here in the end of February. So most of the month of March has gone by, and we really haven't had green days. And if we do, it's usually followed by a day of selling. Even if it does come up, it comes back and fades most of the days. So if we can close strong today, I think that again shows that we finally are finding some bottoms, and we can hope that we can move up for another day or two, and then that way we can drop with some confidence that there are going to be levels to support the price action rather than heading to new lows. Let's take a quick look at the U.S. dollar. We have a decent amount of viewers in here for my normal averages. Those of you that are in here, if you want me to take a look at a stock, you have an idea that you want to look at, whether it's just a chart that you think is good, or maybe one that you're worried about potential support levels or resistance levels, just type it in the chat and let me know what you're looking at, and we'll go ahead and discuss it once we cover the U.S. dollar, gold, silver, and oil. Now, the U.S. dollar, like the markets, has had crazy volatility, just surging back and forth. Very, very strong move. Made its way up to 29 on the UUP index, which is incredibly strong when you look at a longer term chart and you see what we've done. That was a massive move. A lot of volume spike, a lot of craziness coming in here. And some of this is just fleeing to the US dollar, right? This happens a lot. When you have a market that's terrified, you're going to have a fleet of safety and people go to cash, right? So strength for the U.S. dollar. Now, if we look at the individual currency crosses, you look at the forex pairs, and you look at the first one we're going to look at is the euro U.S. dollar. Now, this is going to be inverse to that the last chart we looked at, because in this case the up is good for the euro and down is good for the U.S. dollar. You can see the strength the U.S. dollar had, but it was only after the euro had exploded, and then we finally had that big move, and now the euro is starting to kind of recover. But more than anything, you can see the crazy volatility. Um, Hopefully that volatility could die down and we can start to get a little bit more of a stabilization here of currencies, because at the moment it's very difficult to pin down what they want to do next. And I'm kind of at a loss here as to figure out what's going to happen next. You would expect at this point with the big V reversal like this, that bullish move the euro had has been completely canceled out, and with the strength that the U.S. dollar has had, it should probably resume and start to push against the euro again. But with these crazy volatile swings, I wouldn't put it past the euro to at least make its way back up into this 109, 110 area, and cause the U.S. dollar to slow down a bit more. If we look at the U.S. versus the Canadian, we'll see a different picture. We'll see a picture of strength for the U.S. dollar, and even when the U.S. dollar has kind of pulled back, it hasn't pulled back much. And this again is because oil has been destroyed because of various different factors, but one of the biggest ones being that there's going to be a much less demand for oil and for energy when half of the population, or 80% of the population, is staying at home. We're not, factories are shut down. There's just not that much demand for energy right now, and you can see it's sliced. Oil's gone down from the 60s all the way down to the 20s. And until we start to see people go back to work, until we see businesses open up again, I don't really expect oil to make its way back up to any real reasonable levels. And considering that's one of the major exports of Canada, you can see the Canadian dollar has really struggled against the U.S. And if there's one area that I expect to continue, the U.S. dollar can continue to hold strength, it's against the Canadian. Now, that being said, it's overextended, and there is room for a drop, and for, especially once oil starts to recover a little bit. Oil's been blasted down to such low levels that it will get a recovery bounce, and when it does, you can expect the Canadian to rally and make its way back, and you'll see the U.S. CAD drop maybe back to 140 or so. But from there, I would actually think this is one that I would expect to be able to make its way back up, and I would consider that a good long trade idea for any of you guys that are forex traders. And then finally, we have the U.S. yen, and you can see again the crazy volatile swings that we've been seeing. Basically, since October, volatility has been increasing in the U.S. yen. And then, of course, once we had this whole coronavirus blow-up, it's just gone insane, going all the way up to 112, down to 101, and back up to almost 112 again. It's coming up into resistance, and more likely than not is going to have another volatile swing to the downside. But at the very least, we have to assume that it's not going to come all the way back to 101, and should probably make its way back up into the middle of this broadening wedge, somewhere around 109, 110, once it rolls over here at these levels. And I think more than anything with these three, what I want to point out is just the amount of emotionality and the amount of fluctuation we're seeing in currencies, which reflects against what we're seeing across the world equity markets. And it just shows you how much of a panic the entire world is in at this point. And I think you can see it reflected on all of these charts, showing just where, what exactly is happening here. As people flow to currencies to try to find safety and avoid the danger that they're seeing in equity markets. Finally, if we look at gold and silver, now traditionally you'd expect gold and silver to do well in these types of environments, right? When you have traders flowing to safety, you'd expect stuff like gold or bonds to do well, but that wasn't the case. Matter of fact, you can see gold had a real sharp downturn with stocks, and part of the problem for this was that a lot of funds and a lot of just individual people needed to raise equity. They needed to raise cash, so they liquidated everything. Anything they can sell, they did. And so, despite the fact that most people have a certain balance of stocks or bonds or gold in their holdings or portfolios, or mutual funds do, they had to liquidate all to raise cash to meet margin demands or just to have cash that they needed to survive and to live. And so they just basically sold everything, and that's why when you see stuff like this, when you see gold drop as well as the U.S. dollar, as well as the stock market, when everything drops together, it shows that they're just liquidating because they need to raise money somehow. And that's what we've seen so far. Now, I think long term, gold is probably going to be more bullish now as we continue to lower interest rates across the world. Uh, we might actually reach a point in the next year or two where we start to see more inflation. If that's the case, then gold should be one of the places that money will kind of flow to protect against that. Not seen it yet, and I don't think we'll see it for a while. But that's something you might want to look at as we start to move forward in this year, and as we start to see exactly what the market's going to do. You might want to start looking at precious metals a little bit more. However, as of now, I don't particularly like to trade charts that have this kind of increasing volatility. That's why I've stayed away from forex recently. I've stayed away from gold and silver. When you see things like this, when you see an increase in volatility like this, and again, trend lines give you the perfect explanation here of where the volatility is going, right? You can use Bollinger Bands or average true range and give you an idea, but at this point, we just connect some of these dots. You can see volatility is increasing pretty substantially. That's usually not a great time to trade unless you're trying to trade mean reversion or sell or trade volatility like range-bound trades. And even then, it's tough because volatility is expanding, right? So what we want to see right now is we want to see volatility start to contract again, and we want to see a pattern that we could kind of depend on. And we're not right now, so I'm not that interested in gold or silver, although I do think there will be a way to trade them soon, and I think that they could be a long instrument, long term, but not at the moment. You can see silver really, I mean, talk about volatility, going from $18 all the way down to 11, and it's back up to 13. Someone that tried to catch the knife and tried to play the bottom probably caught a good trade here, but there's so much potential for this to drop again that it's not a trade that I'm that excited about either. So really, gold and silver, not really my thing right now. Oil, I think there's a potential for an oil bounce. So if you're interested in something like USO or some of these really heavily beat up names like Exxon or Chevron or Phillips 66, any of these gas names, you can look at them for a bounce. But I'm personally kind of staying away from this. I think, again, there are certain areas of the market that I'm focusing on to the long side. And while these names have been beat up and they have room to the upside, I'm not that interested in them right now. With maybe a minor exception of USO, and only because it's trading at $5 and you can get a pretty good premium on the options right now on it. So it's a decent way to play options. But other than that, I'm more focused on tech names as far as to the long side. Rather than trying to catch a bounce. Matter of fact, these are the kind of names that I'm hoping bounce so that I can short them. All right, so that's oil, gold, silver, the U.S. dollar. More than anything, just like the markets, you can see there's a lot of volatility, and it's at this point you can see that there's just a lot of emotions in the marketplace, and we're getting pretty big swings back and forth. And what we want right now in these markets, in these commodities, and in the currencies is the same as the stock market. We want volatility to die down, and we want a range to be established so we can at least understand what the top and bottom is that we can kind of start to count on as levels of support and resistance. All right, so yes, they do pay dividends, JD Bird, and you know what? We'll get into the dividend thing in a second. Let me go ahead and take a look at Disney and Tesla for Butterface, and then we'll look at some at some of these oil names and talk about dividends and stuff like that. All right, so Disney. I was talking to some friends before. They were talking about potential bounce plays, right? And they wanted to play names that have been hit pretty good. And I think Disney's actually a good one. I think, despite the fact that they've had parks closed for a while, which is going to be a big hit on their bottom dollar, at this point, Disney's a multimedia conglomerate. They have, obviously they own a lot of. They own ESPN. They own channels. They own Disney, the movies. They own Marvel. So they have a lot, and it's not just a matter of the parks anymore. And Disney's a name I like long term. So, over the last couple of weeks, I've been mentioning when you have a market like this, you want to go ahead and make a watch list of names that you like, names that you think you want to play, want to get a discount, right? So, um, anytime that we have, and again, the last time we had a correction like this was 2008. So let's go to a monthly chart here, and I want to, I want to point out, so when you have a crash like we did in 2008, 2009, basically, you get discounts, right? You get stocks you could buy at a discount. Anyone that was bold could have bought Disney in the $20 range, right? Anybody that was bold could have bought Apple. Now, Apple, I think, is split adjusted from this price, but they could have bought Apple in what is now basically about $30, right? They could have bought Amazon back in 2009. You could have bought Amazon around $100, right? Um, so when you have these really big corrections like what we're seeing right now, you want to build a list of names that you trust, names that you really like, that maybe you aren't as heavily invested in as you would like, right? And to me, Disney's one of those names. Disney's a name that I like. This is a name that I think is a good long-term holding, and I think will recover. And while there could be more downside on it, because again, it has been hit pretty hard. Not even just the parks, but it's something like ESPN. They don't, how much viewership are they losing right now? Because there's no sports to broadcast, right? So, in the short term, Disney is going to be hit, and they're probably going. There may even be more downside here, but this is the kind of name that I think long term is a good name to hold. And again, look, they have dividends as well, right? They had an 88-cent dividend back in December 19. So I would much rather have this than say Exxon, even though Exxon again is a dividend player as well, right? So we take a look at Exxon's last dividend. It was 87 cents. Now, granted, it was at $62 when it had that dividend, right? And Disney had that 80-cent dividend when it's at $150, so it's not quite the same percentage, but it's a name that I kind of trust a little bit right now, a little to hold up a little bit better than something like Exxon. Now, again, I'm not saying Exxon is a bad idea if you're into the dividend, but just saying that I personally, Disney's one of the names that I do like, and one of the names that I think about long term, right? Tesla being another one, which is what your other request. But so what I wanted to say again was, when you have drops like this, you want to go ahead and look at the weekly chart. You don't want to look at the daily for this. You want to look at the weekly. And you want to figure out where the major levels of support. And you can see Disney, there's a pretty critical level of support here around 91, $92, right? Just under 100. You can go back and take a look at how it traded for the last, what is this now, 6 years, right? And you can see for the longest time it based out, basically trading from about $89 to about $120. Big broad range here. And it slowly started to pick up steam over 2018, 2019, and then it just broke out. And now it's come back and given all of that back, right? But it found support here around $89, $90. It did temporarily go below it. And so what you want to do is you want to find names like Disney that you like, and you want to buy them as they hit these support levels. And as you can see, Disney, unfortunately for right now, Disney has already pushed past that, right? And it's up a good 10, 15 points above what we would consider to be support, and it's starting to approach what would be considered resistance, somewhere here around the 110 to 120 area. However, I think it's still doing okay. And I think right now, if I were looking at it, if you didn't get it as it started to bottom here, it's not probably a good buy right now, because again, it's ahead of the market as far as it's hitting its 20-pair moving average now. Like I said when we were covering the markets, usually when you hit the 20 like this, you don't normally blast through it on the first try, right? So if you want to still go long Disney here, you might want to watch it come back into the $100 range, right? You want to see it maybe print a bull flag around the moving average, and maybe come back and test some of these levels here around 98, 99, which again is that March 11th, 12th, 13th turn in the market. And we're back above that, right? So that's the area that you want to see a support. And I think if you come back and pick some up around 100, that's a good idea. Now, these long-term plays, they're the kind of things where if you have a goal in mind, say you want to own $5,000 of Disney stock, right? I wouldn't have bought all 5,000 already, right? I would have, as it scaled down, as it kind of made its way back up over 90 or 89 or 90, maybe you put in $1,000, right? And then as it comes back and it holds around 98, maybe you add another 1,000, but you save in case it's going to come back down and test lower, and you can scale in a little bit further on it. Because again, these are long-term additions. You don't want to just guess at a bottom. You want to be able to you want to be able to kind of price it in, and if it continues to drop, you still have a little bit of bullets in your holster to be able to add in at a lower price without it being irresponsible of you, right? So I like Disney. I think Disney's a good one, Butterface, and I think the problem right now is that it has moved up very strongly in the last 2 days, going from 92 to 105. So at this point, I'd like to see a pullback before I try to get in. I think the day to get in was yesterday as it broke 98, or even a couple of days ago when it was breaking 92. And for now, I think it's at a point where you just have to wait and see it come back to a level that you like. And I think it's going to be very similar with Tesla. This was one that I made a big change to in my parents' retirement accounts. They had missed this entire move, like a lot of traders have, missing everything from 300 to 1,000, right? And so this is a stock that I constantly get questions, hey, when can we put Tesla? When can we add Tesla? And so what I did was I finally switched a bunch of holdings into Tesla to be able to get it, and we were able to get it from basically around 385, 390, and get a nice little bounce up here up into the 500s. And just like Disney, this is a stock that a lot of people missed out a big move and have been wondering when can they get in. But what happens is when you get these drops, then traders, they lose confidence and they're like, well, I don't want to get in now. Maybe if it keeps going down, and they freak out. But if you think about it, we're getting almost a $600, well, at this point, a $500 discount on this stock. Now, granted, I don't think it's a $1,000 stock yet. I think that it got way ahead of itself as it broke out and started to trade above 6 all the way up to 1,000. But I think it's definitely a much better value than a $300 or $400 stock, right? So at this point, a lot like Disney, what we want to see now is, again, we want to see a pullback back into this area around 470, 445, and then from there we can hope that we get a good price. Yeah, JD Bird, dollar cost averaging is for sure the kind of thing you want to do here, and that's exactly what I'm going to say with Tesla as well. With dollar cost averaging, you want to make sure that you are not trying to add everything at one shot here, right? Because there is a chance that this continues to drop. There's going to be a lot less money in the economy right now. With, a lot of people are losing their jobs, and a lot of people will lose their jobs. And so, premium vehicle like this, they might have slower sales, and as a company, they might take a hit. So there is a chance for them to drop, and there's probably very little chance of them to get back over 1,000 anytime soon. However, if you like this name long term, then yeah, you want to get in as it hits these lower levels, right? And unfortunately, it's already bounced pretty strongly. So we want to see it come back down to these areas, and whether it, hopefully it doesn't make it all the way back to 358, because if it does, then there might be something wrong with it, and it might head lower. But as long as it pulls back and starts to trade back in the 400s, I think that's a good spot to scale in and add to this. So I think both of yours, by the way, I like both of these quite a bit, and they're both names that I always look at long term, and I've added to whether my own holdings or to my family's. And I think that these are the kind of names that you want to look at. Other names, of course, are any of the FANG stocks, right? Amazon is always the first name that I look at, and anyone that's visited my Patreon page knows that I've basically recommended Amazon as a buy for about 4 weeks now. And 1700 was one of the critical levels we were watching as an area to scale in strongly, and that area held up very well and was able to, and we've been able to get $200-300 on it right now. And if you think about it, if there's a company that is going to weather this kind of storm, it's something like Amazon, right? Because a lot of people now, whatever they want to buy, they're just going to buy it on Amazon and have it delivered. And even delivery costs are going to be less with oil prices and gas prices dropping sharply. So this is always the first name I look at for long-term holdings. However, I think any of the FANG stocks are good. Even though Apple's going to see a slowdown, it's such a strong company that you always want to buy this at a discount. You always look back at these prices 2 or 3 years from now and say, why didn't I buy? Why didn't I have the confidence to add Apple or Google when they're at these price points? And so these are the kind of names you want to look at. And you want to make sure you take advantage of them, and make sure you buy them at these critical levels. So now, JD Bird, you wanted one of the things you were talking about was dividends, right? On stuff like CVX, ConocoPhillips, and I agree. I want to point out one thing though. Um, you see this $1.19, right? $1.19, $1.29. If these stocks are trading in the 70s and 60s, these dividends are going to be cut, probably quite a bit, and you're not going to get the same dividend. Now, percentage-wise, maybe you get the same dividend, but there's going to be a pretty big hit on the dividend as it starts to trade in lower prices, and I suspect that it's going to be a lower percentage as they cut back a bit to try to save money and to try to recover from these drops, right? So that's the one thing you want to be careful with these names is that you understand that a lot of them are probably going to have dividend cuts. Now, that's not saying that you don't want names with dividends, right? Because you do. Um, a lot of times in your portfolio, you want some of these safer names that are going to give you dividends, and you want to make sure that you have access to this kind of monthly income, right? Particularly if it's a retirement account, you want to make sure that you get your dividend on these things, and that you're able to, it's like kind of like collecting rent on a holding. And that's something that's important because even if you're valued, like so your holding just cut in half, right? If you're only concerned with ConocoPhillips in your account is to collect dividends, then I mean yes, you care the price of ConocoPhillips, but it doesn't bother you as much as long as you get to continue collecting your dividend. As long as your dividend doesn't get destroyed as well, then I think you're okay with some of these price drops. Now you don't want it to drop from 70 to 30. But anytime there's a $5 or $10 fluctuation in the stock, you don't care because all you're doing is collecting dividends on it, right? So what you want to do in these situations is you want to make sure that you're picking names that you think are stable and aren't going to struggle to recover and aren't going to cut their dividends too poorly. Now, I'm not an expert at this, so I can't tell you for sure who and why they're going to cut their dividends, but I do know that you should be careful that you don't want to just look at what the dividends they've paid out in the last year and assume it's going to be the same going forward because there are definitely going to be cuts in dividends. One, related just to the price being lower, but two, if the companies need to kind of raise cash or kind of make sure that they're saving their capital for something else. I agree with you, and you know what? A lot of these companies also they always have hedges on their oil anyway. Although they're going to get destroyed on the hedges because oil's dropped so much in price. But I agree with you that they do have a 50-year plan in place. They understand the cyclical prices in oil and nature. So do the airlines as well. They do hedge their oil well in advance to make sure that that they're getting consistent prices regardless of where gas trades, and that's critical. But this goes beyond the price of oil, right? At this point, there are less people filling their gas tanks. There's a lot less energy being consumed generally across the board, and I don't know. I worry sometimes too as the transition to electric vehicles, but that's something that's still for 20 years from now. I don't think that's something we need to concern ourselves with in the short term. But that's another thing that I worry myself with some of these names. Now I do like, by the way, there's a couple other. They're going to get hit just like everything else, but I also do like some REITs for dividend plays as well. Something like American Tower, they have a nice dividend as well, and they basically it's a real estate investment trust. So you might be worried because real estate in general is going to get hit, but these guys they own cell towers, right? So they're not quite in the same space where they're going to have trouble collecting rent from businesses or whatever it is. This is a company that basically owns real estate, but they're cell towers that they hold. And it's a name that I've liked long term as far as a dividend play is concerned, and one that has done very well long term, as you can see. So, like, just to kind of go off of oil for some people, if you have confidence in the oil names, that's great. But some people don't, and if they don't, and they want to look for other avenues to pick up dividends, I think this is a good one as well. Another one I like quite a bit, although I think it's going to get hit pretty good right now, is O. These guys are, they're another real estate investment trust, but they I think it's mostly commercial real estate, so they might actually get hit more as we move forward. But this is another name that you can see in the long term has done very well, and they also are a nice dividend producer as well. So these are a couple of dividend names that you can also examine and see. Now their dividends aren't that great. You can see it's only about a 20 cent dividend. But because it's such a good performer, it's not quite the same. I consider it more of a growth stock than anything else. But um, I think AMT is a good one, and one of the ways someone can maybe protect themselves a little bit as we move forward, depending on how we do. All right, so Wes, you have a question about Qualcomm and other 5G tech companies. I think, generally speaking, they're going to hold up better. Now, are they going to hold up as well as something like Zoom or Citrix? No. You can see Zoom has been doing awesome. By the way, another one of the names that I recommended on my Patreon page, Citrix. Now, these guys are going to do well because the more people work from home, the more they're going to use their services, right? Now, stuff like Qualcomm and the 5G stuff, the problem with them is that it's still for the future, right? This is still something that you're looking at when 5G comes out. A lot of this is going to be based off cell phones, which to a certain extent is, I mean, it's hard to call it disposable income anymore because they're so essential to our everyday life. Um, but yeah, I do think that these names are going to hold up, and I think that these names have very good potential for the future. Because eventually everyone will have to use 5G technology, and once that happens, there will be a big ramp up across the industry. So I do like Qualcomm to a certain extent. I think it falls right in that little bag of tech names that I would just consider, and I think that this is the kind of name that would do pretty good. Um, to a certain extent, even some cell carriers, like T-Mobile hasn't done too poorly yet. Although I'm a little bit wary about retailers just in general because of a slowdown in spending in the near future. But you can see T-Mobile's held up pretty well. Obviously, Apple hasn't done too poorly. I mean, it's dropped quite a bit, but generally speaking, when you compare it to the markets, it's still holding up all right. So I do think that these tech names, a lot of the 5G stuff is good. I don't know any other 5G like specific tech plays off the top of my head. If you know any other ones, we could look at them. But I think that they're all pretty good. Um, Another thing I like I said before, is when you look at the tech space, look at some of these, like I said, some of these companies that provide the kind of infrastructure we need, whether it's for cloud, for working on the cloud or working at home, or just networking in general. And you can see a lot of them are they're doing very well, right? Even another name that I liked and pointed out was this one, DocuSign. Again, pretty important for people that are working from home. And I think all of these, as you can see, it's almost like we didn't even have a market correction, because generally speaking, their business has actually gone up, as we've kind of struggled with this market. Microsoft is another one. A nice, Microsoft is interesting because they obviously do sell computers, so they're going to take a hit as far as slowdown in economy, but they also produce work software, right? Like Excel and Word and all that. And they're a pretty important name for working from home and working from a computer. And as you can see, they've kind of like Apple, they've taken a hit, but for the most part, they've weathered the storm pretty well, and they're starting to kind of pick up again. Adobe, another one, very similar to that, doing a decent job, and kind of weathering the storm a little bit as far as where it could go. You have other stuff like Team, which has done well. I know I'm giving you guys a lot of names, but these are names that I think are pretty good. Teladoc is another good one, which allows you to basically interact with your doctor through a cell phone app in order to avoid having to go there. There's a lot of stuff that, if you just dig in through the tech sector, you can see there are names that are actually holding up and doing well because they're not really affected by us staying at home. And so I think those are all good ideas. And yes, Wes, I like that. I like the 5G idea. I think that as we move forward, there could be more growth in that area. And I prefer that to some of these other areas that have been beat up, even though they might have temporary bounces. Now, on the opposite end of that spectrum, of course, you have stuff like the cruise lines. You can see Norwegian has had a huge move up the last couple of days, right? Now, personally, I look at this like, I could finally look at a short, right? As this starts to roll over, then now we've got room to go back to the downside, whether it's a cruise line whether it's something like, and I know, the danger with this is that all this stuff is getting bailed out now, right? So there's a chance that they continue to move back upwards. But um, when I see stuff like Boeing finally start to recover, airlines like Southwest, you see Southwest got above its 20-period moving average. Delta is starting to get a big bounce. When I start to see these bounce, this is finally, it's one of these things where you wanted to short these names and then you never got the opportunity because they just went straight down. They're finally starting to bounce, and I'm not saying to short them today or tomorrow, but as we start to reach whatever the top is of whatever this bounce we're getting is, these are names that we could start to reevaluate and see whether they're worth shorting again, depending on how they react again to the stimulus package and just what kind of money they can expect as they get bailed out. But my suspicion is that despite the fact that they're getting bailed out, they're still not getting any business. And it's the bailout's going to just keep them in business, but that doesn't mean that their stocks should go back up to what they were trading before, because people still aren't flying. People are not going to be taking cruises for a while, and so a lot of these names are still going to take another hit. Same thing with the casinos. There's a lot of them that have recovered pretty well recently. Again, look at Las Vegas Sands, actually above the 20 period, so ahead of what a lot of the market is doing. But people are not going to really be gambling still, and so there's still a chance for it. These are areas that you can see are recovering, that if you're not interested in going long the market and you're looking at shorts, we can always revisit these types of names, and see what they do. All right, so we got a lot done today. It was a lot of stocks to look at. I want to thank Butterface, Ray, and JD Bird for participating, and anyone else that visited and watched. I'm glad as well as US. I always appreciate it when you guys give me stuff to talk about. It lets us kind of go over a lot more, right? So you give me one name, and that gives me an idea to go over another 5 or 6 names. So I always appreciate when you guys actually participate and give me stocks to look at, because again, it spurs a conversation forward that could get us to start looking for other names and other ideas. So we'll look at how this performs next week. We'll meet again next Wednesday as usual. Kind of be careful out there. Don't get too crazy trading. Don't start getting too caught up in this bounce in the market. We'll see how we go from here. But my suspicion is that we could bounce a little bit, but I still think there's more downside. So whether you missed out on a long or whether you missed out on a short, I think we'll have plenty of opportunities on both sides over the coming months. And so it's a good idea here. Just be patient and understand that the market is in a very volatile state. But that volatile state is also going to give us a lot of opportunities as it swings back and forth. Okay? So hope you guys have a good rest of this week, and we'll meet again next Wednesday.